All right. Good morning. It's the Ingles and Engle show. Welcome. Half an hour to the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China show. I'm David Ingles with Stephen Engle.
And our top stories this morning: the dollar edges higher while stocks are trading with caution after President Trump orders tariffs on Colombia in a dispute over deported migrants.
Now, China's securities regulator makes a fresh move to support the equity market, announcing measures to boost index investment products.
Plus, we take a closer look at Chinese AI startup DeepSeek, whose latest models are posing a challenge to U.S. rivals despite Washington's tech restrictions.
Good morning from the Asia Pacific. Happy Monday morning again, and hope you're all well rested as we get underway. Of course, a fresh trading day, a fresh trading week, a truncated one, really, as you look across most markets in the Asia Pacific, given, of course, the Lunar New Year is upon us, really, in many markets. We'll get to that list, of course, of markets that are closed today in a moment here. But certainly when you look at price, volumes are mechanically substantially lower at this point in time, given a lot of the closures so far. So we should have Taiwan coming online at this point. We don't across other markets as well. The other thing I want to mention, though, is we are seeing some upside still across the benchmark today. MSCI Asia Pacific, and I think that should make us 6 days in a row as far as gains are concerned. We do seem largely unperturbed with a stronger dollar, which has actually rebounded from that massive drop that we had on Friday, which actually took the Bloomberg dollar gauge to below the 50-day moving average. A lot of that, of course, had to do with sort of the tariff relief and that, markets pricing out some of that risk premium attached to tariffs. But you know what? Here we are Monday morning. It's a fresh start. And again, we're talking about tariffs on the opposite side of things. Right. Now, all that being said, though, the approach to the Chinese markets today was one really where you look at the Golden Dragon Index, and these are the stocks you'll want to watch very closely today. On the back of this Czech rally in China, the biggest gain on the Golden Dragon Index, you have to go all the way back to November to see a gain of this sort. And of course, the latest one here as well, and something that we're trying to figure out how to sink our teeth into in the public market space, is really this DeepSeek story that's really caught the world by storm, right? So you look at some of the AI plays in China, want to watch as we get underway today. A50 futures coming online, and we should be seeing a little bit of downside right now, some weakness coming through in some of these benchmarks. Dollar China 725.29 against the U.S. dollar. Now, on the exchange rate itself, that's at an 8-week low, give or take there. That's one to watch, of course, as we get underway today. Apart from that, sectors we talked about: tech, AI, EVs, on perhaps potentially more policy support for the sector as well. There's a lot of earnings to get through as well. SAIC, China Life, on the back of the Friday news coming through just after the market close. Now, all that being said, of course, we're also going to get into a lot of data today, including, Steve, PMI numbers set to come through.
Yeah, absolutely. I mean, we saw the PMI in China go above 50 for the last 3 months following that September stimulus bounce, but barely above 50, Dave. And of course, we know 50 is that demarcation between positive sentiment and negative sentiment. We're expecting right on the line. They're going to be balancing right at about 50. Or 50.1, as you can see, it would be the same as December. But, these 3 months of positive bounce, is petered out. It had 5 consecutive months below 50 before that. So this is a good pulse check, if you will, on whether that policy fatigue and the promise fatigue is really starting to set in, of course, about a month away from the National People's Congress coming up in the first part of March. All right, well, Colombian assets are set for a rout after President Trump said he's implementing tariffs and sanctions on the South American nation for refusing to take back deported immigrants. For more, let's bring in Bloomberg reporter Andrea Jaramillo joining us live. So where do we stand right now? There's a standoff, obviously, between Colombia and the United States and Donald Trump's policies. What's the latest?
So the latest is Colombian President Gustavo Petro. He has said that because of the Trump's announcement of 25% tariffs, that Colombia will do the same, and he also announced tariffs of 25%. That's where we stand right now. There's a lot of talk of how Colombia will be more affected than the US in these tariffs. So this happened today in Colombia. It's the evening, and it's still an ongoing story. We're going to see what happens. The government has actually said it will speak later today. We're expecting that to be soon, but they haven't spoken yet. So we'll see if this continues.
Yeah, Andrea, David here. So we know what's been said on both sides. How much do we know about what both sides can really push through with in terms of the application of what's been said and those measures?
Well, tariffs, as soon as you impose those tariffs, really, again, for Colombia, for example, Colombia, about 30% of Colombia's exports go to the US. So this would have a huge impact on the country, where the economy, has not had strong growth. It's expected to grow more this year than it did last year in 2024. But this would have a huge impact across the board. And even, for example, Valentine's Day in the US is coming up. And that's something that people are already talking about, because a lot of the flowers come from Colombia, these beautiful roses, carnations, etc. So this is something that the flower industry here has been preparing all year for. And it's the big event. Valentine's Day is when Colombia really sends a lot of flowers to the US. So things like that, we're seeing, if the Petro government will continue with this, if as industry groups, you see all across the board, people asking, chambers of commerce, everyone just saying, please, let's calm down and let's not do this social media fight, and let's try to figure this out and calm things. So, but tariffs, as soon as you impose them, of course, they're there. So we're following this obviously closely.
So it begs the question, what's next? What happens next? Tensions are running high right now. Calm is being urged, but what's the next policy steps from either side?
We'll see. We'll see what the government says today, if they'll continue. There's already, the U.S. has said that it's not going to. We're seeing that, starting tomorrow, they're closing. They closed the visa process for Colombians looking to have a visa to go to the U.S. So we're already seeing the impact. And again, the question is if things will calm down. For now, as you mentioned, we're going to see markets open again. This is evening in Colombia, so when it's tomorrow for us, Monday morning, we will definitely see an impact across the board. Currency, bonds, you name it, we'll probably see it.
Absolutely, Andrea. In fact, you're already seeing that across some of the proxies right now in the Asia Pacific. So we'll keep on top of the story, obviously. Andrea Jaramillo there in Bogota for us on the latest here on this. Again, something to think about following, I think, markets. A lot of people in the markets on Friday forgot that tariffs are still part of the conversation, aren't they? Paul Dobson's with us to talk us through the big picture context here, executive editor for Asia markets. He joins us out of Singapore. Yeah, Paul, I was about to say, so dollar is stronger against, I've mentioned a proxy here, Mexican peso. It's weaker, though, against some of its major peers. Dollar China still holding up near highs of November. How do we read into what seem to be idiosyncratic stories right now?
Yeah, morning, David. Well, no, I think that, as you said, last week we got lulled into something of a false sense of security that Trump was going to be playing Mr. Nice Guy this time around. But the fact that we've now got a reminder that tariffs can be imposed pretty much ad hoc, at a whim, or if there's something that he doesn't like, has shaken the market somewhat. And so, like you said, you're seeing those proxies in terms of emerging markets that relate to Colombia, like Mexico, but also the South African rand, for example, coming under some pressure this morning because we're having to recalibrate once again on exactly what those expectations for the tariffs are. And it's rippling further as well. You know, we're seeing some expression of that as well in US equity index futures this morning, which are also lower. So the market having to think this through once again. There was a report by Goldman Sachs at the end of last week talking about the euro, but saying there maybe 2/3 of the premium that had been factored into that currency as a result of people worried about tariffs had been unwound. So if the threat is there again, then you could see people starting to express that and putting some sort of a premium back into the price.
Hey, Paul, Steve here. How should investors in this part of the world, as they wake up Monday morning, kind of look at the whole DeepSeek phenomenon, if you will? Obviously, the Magnificent Seven has powered the S&P 500 to great heights, but there's some cracks being shown by some of them, essentially on how much money they're spending on AI compared to DeepSeek. And we're already seeing the headline for the Japanese stock showing a touch of DeepSeek angst this morning. How should we be reading this?
Yeah, really interesting, this one, isn't it? It really seems that the world had a bit of a prise en conscience about it all, started to take notice, a bit of a wake up over the weekend. So we've come in this morning and it's the word on everybody's lips. Is it possible to get more out of existing chip technology in the AI space? And if that's the case, then do we need to see such humongous investments in the chips and in the data centers that have been planned and rolled out? And remember, just on Friday, we saw really big investment plans coming from the likes of Meta, sort of saying we may end up overspending, but we've got to be in this race. You don't want to fall behind, kind of thing. So this creates a little bit of a different sort of perspective on things. I think that investors will probably look to express that with a little bit of concern about the valuations of US tech. A lot of them are reporting earnings this week, remember, so we'll have to see what they say when we get from that as well. But then back over in Asia, maybe there's some hope for alternatives, particularly China tech sector. So we'll be watching for the companies in the mainland, in Hong Kong, that could benefit from this technology as we get going on trading again today.
Paul, fantastic. Thank you so much. Paul Dobson there, our executive editor for Asia in Singapore. On Paul's point right now, before I get into what this week has in store for us, so we just mentioned that Baidu is, well, in the cash markets on Friday in the U.S., substantially higher, substantially here in Hong Kong higher. And going into the open today, we're now called at about $84 here on Baidu, which is about $2 in the pre-markets on the way up. I'm also looking at the likes of SMIC, for example, which is, of course, your TSMC play, if you want to put it that way, here in the Greater China region. So a lot of stocks we're tracking here going into the open today. Right. Okay, let's have a look at the week ahead. Right. So apart from all the data that's going to come through today, so PMI numbers are out in about 17 minutes from now. The big one, of course, as with most weeks when the Fed is on deck, is the Fed, although we're not expecting any change there out of the Fed, looking at pricing as well. We move into Thursday, of course, where really the ECB is really the key question here. At one point, the last several weeks, was it 25 or 50? It certainly is a cut that's going to be on deck today. And really, what is terminal rate for them to the downside? What is neutral rate at this point in time? Is it 4 from here? We'll see what happens with that. But apart from that, though, it's going to be a very quiet week as far as markets go, Steve. Yeah, markets go dark in China for the rest of the week. It'll be interesting to see some of the data that comes out today, especially after what we saw Friday with the NASDAQ Golden Dragon Index up 3.7%. A lot of that is actually Trump sort of backing away, not really backing away from tariffs, but essentially in that Fox News interview saying he didn't really want to do it, but that tariffs, in fact, hold a lot of power over China. So the tech rally in the U.S. Yeah, it's certainly something to watch here. Like if it was completely up to him, if it was only that, he would rather not have to resort to imposing tariffs on China. Okay. All right. Well, still ahead, we'll be joined by Lung Properties Chair Adriel Chan after the company reported a 25% drop in profit. Plus, we'll get his views on China's luxury retail sector. And we're also counting down to the open of trade in Shanghai, Shenzhen, and that city right there where we are now, Hong Kong. This is The China Show. Good morning. You're watching the China Show. You're just in time here for the reference rate of the day. Unsurprising that I wouldn't call it the pushback, really, just the anchoring relative to expectations is the narrowest we've seen in months, given the fact that you had a massive drop in dollar China last week. In fact, at the current levels, we're trading at about 2-month highs here on the Chinese currency. Perhaps less room for, or less need for the PBOC to anchor things as well. This is a very fluid conversation, though, Steve.
Yeah, that's right. We're going to switch over to the equity markets now. China has announced measures to promote index investment products to support its ailing equity market. Bloomberg senior equities reporter Abhishek Vishnoi joins us now from Singapore. Obviously, last week, Abhishek, we got comments from Chinese officials. Now we're getting another statement from the CSRC, essentially wanting to attract, or at least put in some policies to attract index funds as well as foreign direct capital into the A-share markets. How much does this move the dial?
Well, it's important, and it's happened on expected lines. I mean, a few years ago, we saw actually passive investments or index-led investments overtaking, active investments. Passives largely flow, shadow indexes, and we have seen similar trends happening in China. So it's on expected lines. This may look like an incremental move, but if you look this from the lens of what was announced, from CSRC and PBOC for insurers and pension money to come in the market, long-term funds ranging from a few trillions to about 13 trillion yuan annually, as per JP Morgan's estimate. This is a big push. So this will increase the institutional ownership at a time when retail investors in China are shying away from the stock market. It provides that necessary support, and this should be looked in conjunction to a lot of other things that China has been doing, right from on the monetary side to promises on the fiscal side.
Okay, Abhishek, like everyone is talking about DeepSeek now. So, what is your take? How do I watch that today?
Well, we actually did a lot of reporting on DeepSeek as and when the news had hit the wires, and you can see the divergence in S&P futures and Nasdaq futures. Nasdaq futures before I came here were down about 1.6%, and S&P futures were down, but just a tad lower, like 0.5% or something. So this divergence essentially shows that DeepSeek's advances are actually, or might actually be becoming worry for mega cap US tech stocks. I was talking to a few traders. They said what news flow has come on DeepSeek side is negative for Nvidia. Long only funds that we talk to, they're a bit more hesitant in committing. But if you talk to analysts, if you talk to traders on the ground, they want to shoot first and ask questions later. They see these advances actually showing that when you put someone so much in the corner, there is, the upside is the only way. Low cost, advances in tech despite these restrictions. All this essentially shows that U.S. curbs on, China's advancement towards tech supremacy, that's sort of dwindling a bit.
Absolutely. And I would imagine this is just the start of this longer coverage we'll have on this. Abhishek Vishnoi there in Singapore for us, our senior equities reporter. I mean, the Chinese, they've done it with cars, name your industry. It's hard to imagine they can't do it with AI, right? And certainly the events in the last few days are a kind reminder, or a harsh reminder, depending on which side you're sitting on as well. Right, Hang Seng Index going into the open today. You're looking at futures as well. Dollar China and just a couple of names we'll tell you about on the other side of this break. We're called higher ahead of the Monday open. This is the China Show.
And welcome back to the China Show. Here are some of the major corporate stories we are following this Monday morning. The Chinese partner of General Motors says preliminary profit for 2024 may have fallen by as much as 90%. Yes, 90, due to a write-down of the joint venture and a bruising price war domestically. SAIC Motors says in an exchange filing that net income could be as little as $207 million. That would see it tumble into the red with a loss of up to around $829 million. Well, China Life Insurance says 2024 profit may have jumped by as much as 144% from the previous year as a stock rally boosted investment returns. The nation's largest insurer by market value sees net income of up to $15.5 billion after it seized market opportunities to conduct cross-cycle allocation. China's CSI 300 index also jumping about 15% last year, spurred by government stimulus.
Yeah, and we're looking at likely gains again at the open today and Monday. So I think we're now up, 6 straight days across the region. We're building on quite a substantial pop and rally on Friday on these benchmarks, and hence why we're trading at 4,700 now on the HS Tech Index. So as you can see, it's really a growth story that's underpinning this. On top of the pivot we had last week, this sort of relief, this tariff relief narrative is now you have on top of this DeepSeek conversation, and people are trying to figure out, do you trade, is it one trade over the other? Is it mega caps that take the back seat, U.S. mega caps that take the back seat in favor of this, as I guess many funds try and use this as a tactical opportunity to maybe close an extremely large valuation gap, I should note. Baidu up 3%, some of your big tech plays mostly higher. Alibaba, Tencent, though, is down about 0.7 to 1%. There are, though, a lot of other names which are set to get up and running on the mainland, which also have a more direct sort of correlation between the AI story there. So the likes of iFlyTech, for example, and the other. We'll get to those names at about the open. SMIC, bottom of your screen, Hong Kong listing up 1.6%. Chinese EVs. Okay, let's have a look at that. So Steve was just pointing out some of the issues and challenges as it pertains on earnings overlay on SAIC. The policy support here is China's looking to explore relaxing and scrapping some purchase restrictions that could actually help the sector. So we'll leave that there for now. And of course, we're minutes away from the PMI number, Steve, coming up.
Yeah, that's right. We're expected just 50.1 maybe. I think one estimate that I saw, the consensus was about 50.0.
Yeah.
So that is the tightrope between contraction and expansion of sentiment.
Yeah, 50, which it's the threshold, as you can see, what's the definition of this in the dictionary, I think, which separates the number of optimists
from pessimists.
Yes,
there. And you can see after stimulus in September, the pessimists got squashed, but it might return back.
Hopefully they stay under the woodwork for now. The open is next. Happy Monday. This is The China Show.
And welcome back. You're watching The China Show. We are, of course, counting down 42 seconds to a number of different market opens, including China and Hong Kong. And we are going to be taking, I think, all morning, Dave, a deep dive into DeepSeek and related stocks, as those are going to be in focus this weekend.
Yeah, deep soul seeking. Really, if you look at, and by the way, I should also mention, right, so NASDAQ futures already on the way down on this. I guess this is the binary trade, at least for now, right? This sort of almost a zero-sum game. So NASDAQ futures are down. A lot of the names listed onshore in mainland China are soaring, that are tied to, even loosely tied to this AI theme. So we'll talk about that in a moment. Also coming through any second now will be the PMI numbers, which we'll get to in a moment. Just to briefly mark the open for you. 0.1% to the upside. Shanghai Comp, CSI 300. Most of the heavyweights, bottom of your screens, are on the way up as well. Flip the page, please, if we can, and let's take a look at some of the names here in Hong Kong. Hang Seng Index 20,147. And yeah, Steve, some breaking news right now.
Yeah, manufacturing PMI dipping below that magical number of 50, 49.1. So a significant miss. The survey was for 50.1. The previous month was 50.1. So January, manufacturing PMI 49.1. So breaking the string of 3 consecutive months above 50. Of course, that coincided with the release of stimulus at the end of September. So we had pop upwards in manufacturing sentiment in October, November, and December. January, we're right back down into below that magical number of 50, 49.1. Non-manufacturing PMI, services PMI, also a significant drop below what the trend line has been of late. We've been having 52.2 services have always outperformed manufacturing in this latest downturn of the Chinese economy, but 50.2 for the non-manufacturing PMI. So it's basically teetering on that line, Dave, between expansion and contraction of sentiment. Composite PMI is reflecting that, 50.1. So this does really reflect there's some pessimism going on in the manufacturing space with overcapacity, export pressure, obviously with the threat of Trump tariffs, and just the lack of meaningful, tangible fiscal stimulus is also weighing on that sentiment, Dave.
Yeah, the tailwinds for this specific data set really came in the form, as Steve was alluding to there, in the form of front-loaded exports. And
yes,
certainly that went away in January. In fact, not just in China, right? You look at some of the proxies that help us understand why, our folks at Bloomberg Economics actually had a forecast of 49.7, I believe, is because they had to look at the data coming out of South Korea, some of the oil refinery run rates, and they suggested that this one was actually going to come in softer than what the market had been pricing in. So we can revisit that story later on. The other story that is now dominating news, which I imagine will be our top story moving forward, DeepSeek related stocks. Let's have a look at the open here in mainland China and some of these names that are just pushing through the ceiling. There we go. On your screens right now for you. Right, so that's a look at that very, very quickly. China Life, A and H shares also coming through as well. So we did get some guidance coming out of the company. Prelim full year could double because of the market rally. We're up a little bit, largely priced, really, given that the catalyst there was really a market that took a while anyway to come alive. SAIC. Right. This one is actually the opposite side of the guidance here. Although we are up, as you can see, 3.5%. Guidance here out of the company. Profit could fall as much as 90%. Let's have a look at other names we're tracking here as well. So you have New World's Development. We'll continue to follow that story, of course. Stock is up 4%. Some of the bonds, of course, substantial bounce on Friday. The statement out of the company. It did confirm that there are several potential buyers for some of its assets. And the story across mainland assets here is China Vanke, 3.5%. It's actually looking to call in some of its bonds. We can talk about that later, but as you can see, it's a very good day, of course, across these markets.
I think it's a broad rally because our next guest, his stock is up 4% in the early going. Hang Lung, 101 HK. The developer last week, I'm talking about Hang Lung Properties, reported full-year underlying profit that missed estimates. Joining us now, as I just referred to, is the Hang Lung Properties chairman, Adriel Chan. Adriel, thanks so much for joining us here. So we all know that underlying profit for the full year 2024 was down 25%. There were a number of provisions due to a number of projects in mainland China and also Hong Kong. Where do you go from here? And what can you attribute particularly to that underlying profit drop?
As you rightly pointed out, Steve, a lot of that was provisions. There have been revaluations. The sentiment around the China market is just not that strong, and so that's where a lot of these one-offs came in. However, if you look at our underlying numbers of just rental receipts, in mainland China we're only down 4. So it's a lot less bad than perhaps the numbers would suggest. In Hong Kong we're down 9, and that's not great, but there's also a couple of one-offs in there, adjustments for leases that were restructured during the year. So Hong Kong, if you were to strip that out, is only down 3. So mainland China down 4, Hong Kong like for like down 3. I would say that even though these are negative, it's not nearly as bad as people were perhaps expecting. Now mainland China retail, so shopping malls, that's our main business, has been a mixed bag. Some of the first-tier cities, luxury definitely struggling. I think if you look at the LVMH numbers, the luxury brands are kind of down 20 in mainland China, and we're roughly in line for first-tier cities. But if you go to second-tier cities, the luxury is actually not as bad. So it's down high single digits, and non-luxury for us is actually doing significantly better. So a little bit of a mixed bag for us.
Do the one-offs remain one-offs?
The hope is that they do. Nobody wants to revalue, too frequently, but that's the hope right now. We have a couple of new projects in Hong Kong. We announced the Wilson Road acquisition, and that's sort of proof that we have some conviction, at least on the high end of the residential sector here in Hong Kong.
I want to go back to the retail space and luxury retail, like Plaza 66, I believe, is in with Nanjing Shilu, is it? Yes, one of your flagship stores. I think the retail sales there were down 22% in 2024. How much of an example is that of the dwindling luxury sales? And do you expect a rebound this year on the back of expected stimulus coming in March, perhaps?
So I think this is pretty representative of the market broadly in mainland China, down 20-ish. I wish I could say that I was expecting a big rebound. Unfortunately, I'm probably not. I think what this is that normalization after COVID. There was a big COVID pop. If you remember, we were up kind of 200, 300% in terms of retail sales during COVID. And this is just that normalization. So if you compare our numbers to 2019, the retailers are still doing about double of the retail sales. So if you take it in context, it's always a little bit different. And I really like, that the retailers are still doing quite well, all things considered. This 1 year number is down, but I think we're normalizing.
And what are you hearing from your partners in terms of their expectations for this year?
So the partners, they're always, looking quarter by quarter, month by month, week by week. So they're always kind of shifting. The latest that I've heard is people are hoping for a little bit of growth in 2025. That's also what we're budgeting, and so we're taking their tack.
What about, you mentioned outside of the big cities like Shanghai, for example, that Steve alluded to there. What are you seeing there?
So the big cities, Shanghai, where cost of living is much higher, I think is being hit more. People are definitely watching their spending. But the second-tier cities, third-tier cities, where cost of living is not that high, actually people seem not ebullient, but they're definitely less concerned and don't have the same burden that the first-tier city residents have.
Let's come back here to Hong Kong. We know that there's a real struggle right now in commercial real estate, and residential is another story as well. But we saw that office and retail rental revenue falling about 10% in Hong Kong and 8% respectively in 2024. What's your leasing strategy for a turnaround against these macro headwinds?
Absolutely. So, like I said, there were a couple of adjustments in specific leases that caused that number to look like 10%, but the like-for-like is closer to 4, I'm sorry. And so Hong Kong is definitely challenging. The office market is pretty dry. Obviously, here in Central, we have a couple of new buildings that have come up. And so I think there will still be pressure on the office demand.
What kind of vacancies are you seeing?
So we're pretty lucky, actually. So we've been up on our occupancies on 2024. So we've done a really, I think, solid job. That being said, the rentals have to suffer at some point if you're going to keep your occupancies up. And that's true for Hong Kong, just as it is for mainland China.
Yeah, so I'm wondering, when do you think overall, not just your properties, when do you think overall the equilibrium starts trending higher in office?
In office, that's tough. I just, to be honest, I don't really see the end of the office troubles just yet. I'm a little bit more hopeful for retail, but office, everything from supply to demand, both sides are a little bit struggling.
Now, I know you won't comment necessarily directly on any competitors like what's happening at New World, and we know New World has a much higher debt-to-equity ratio, upwards of 92%. I think the full year you were about 33, 34. So it doesn't necessarily, New World's problems don't necessarily reflect a broader systemic problem. But if we're into a deeper downturn, how much of a microcosm is the debt stresses at that competitor reflective of the overall health of this market?
Look, we're in a very different position, so we're looking at things a little bit differently. That being said, I think that if there were any sort of, big issue, kind of crisis in Hong Kong in developers, that would definitely move the markets, including us. So in as much as our markets are very different and we do different segments and different geographies, that would definitely have an impact on us. So we're all hoping that all holds up.
How would you describe the fundraising environment in Hong Kong for your industry?
Fundraising has been tough. I have to give my team a lot of credit. We just signed a 10 billion syndicated Hong Kong dollar syndicated loan. I think we caught a little sweet spot. If we had done it just a couple of weeks later, it would definitely have been more expensive and may not have gotten that scale either. So fundraising continues to be challenging. That being said, I think there is a divergence between high quality names such as ourselves and the broader market. So I think we were very lucky to catch this window.
What are you looking for? It was part of the second part of my earlier question about stimulus coming up potentially at the National People's Congress. A lot of it is focused on boosting consumption, which would help your retail portfolio. But what would you like to see on property and assistance to developers and even home buyers?
So consumption is the key for me. That being said, for property, I almost feel like no matter what they do, it's going to be a little bit of time before the overall market recovers. It's a sentiment issue. It's a structural issue. There's just so much going on in that property development box that it needs to be unpacked. I don't expect that. I don't expect a strong recovery in at least a year or two. So I think that we're going to be in this little bit of a slump for some time. But that being said, there's always going to be bright spots that you can find in that darkness.
What's your appetite for acquisitions, though, in mainland? If there are distressed properties there, distressed developers?
Like you said, we're already at 34% gearing. That's pretty comfortable for us. We wouldn't like to bring that up too much more. That being said, you're right. There's some great deals in the market, and one has to be active looking at those. So I think we would be open to some very, very carefully selected, highly, yielding potential investments, but nothing to announce just yet.
What would be your threshold of debt to equity ratio to do an M&A? We've seen the problems at New World up at 92%. Yeah. You're comfortably at 33%. How far could you stretch yourself on gearing?
So I would rather not stretch myself anymore, to be totally honest. But there are ways to do things which don't require a lot of capex. A couple billion here, a couple billion there is not going to move the needle too much for us. So that would be very selective, but you're definitely seeing a lot of good deals coming on the market.
Right. And just to wrap up, I guess, as a final question. So, the focus has been on some of the provisions, of course. Does that affect in any way your expectations and take-up for your new projects? I know those are not the same because that's existing and new coming up. And I'm just wondering what assumptions you're making right now on the market as you have a lot of stuff, of course, coming online the next, let's call it 24 months.
Yeah, so, sorry, was that for residential or commercial?
Whatever the case may be, on the mainland, yeah. Yeah,
in the mainland, residential is still really slow, so we're not really looking to expand in residential in the mainland. I think what we'd like to see is that stabilization of the market, but unfortunately, that's a little bit slow coming. Retail, I think, in the mainland is still kind of soft. In a way, I feel like we've hit pause starting from mid-year. Okay. Things look very much similar, definitely not worse. And in the fourth quarter, things actually even got a little bit better, so that gap narrowing. So cautiously optimistic.
Okay. Adriel, fantastic to always speak with you. Thank you for taking the time to come in.
Thank you.
Thank you.
Adriel, and Happy New Year, by the way.
Yeah.
Keep forgetting, it's a time of the year. Adriel Chan, the chair at Hang Lung Properties. By the way, you can get an insider's guide here for our clients into the money and people shaking up Hong Kong and the financial hub here in our Hong Kong edition newsletter. It's out with days. It's Monday. It's out every Thursday, so stay tuned for a new iteration of that in 3 days or so. Plenty more ahead. This is Bloomberg. Right, welcome back. And the Monday market story is really this a DeepSeek conversation driving a fairly deep and fairly obvious wedge between Chinese and U.S. tech. And, the iteration of that is NASDAQ futures down 2% and HS Tech is up almost like a mirror image of that on price itself. And it really sets up you have a massive earnings week ahead. You have big cap, of course, in the U.S. Mag 7 is coming out. They're coming out with some numbers as well. And the conversations around this market has never been this expensive and the catalyst waiting to happen, are we seeing that now, is a Chinese AI story that's making some people think, are there plays on the other side of this pond that are fairly valued or better valued?
Yeah, I think DeepSeek, possible friction, obviously, in what has been a one-way bet, obviously, with Mag 7, but also these tariffs on Colombia and the dispute there also weighing on futures in the United States. As I mentioned, the Magnificent Seven tech giants are set to start reporting earnings this week. The results may disappoint investors' high expectations, with profit growth projected to be the slowest in almost 2 years. Bloomberg News earnings specialist Reina Sasaki joins us now. So, Reina, what are the common themes facing big tech, and what are you expecting, for example, from Tesla?
Yes, so Forbes' so-called Magnificent Seven will report slower quarterly sales this quarter with cautious consumer sentiment and unfavorable currency exchange. And Tesla's growth margin likely came in below consensus due to weak vehicle pricing and an adverse effect from a stronger dollar. And the vehicle sales are seen rising 16% this year thanks to the launch of low-cost Model Y SUV, which starts delivery in March. And investors are watching out for the possible impacts from the anticipated rollback of U.S. policy that favor EV adoption.
And Reina, what about the other big names? So Microsoft, Meta, Apple are also on deck with numbers and hopefully better guidance this week. What are we expecting from their results?
Yes. On Wednesday, Microsoft and Meta are expected to post its slowest revenue growth in a year and a half. And for Microsoft, growth in IT spending was likely to be offset by currency headwinds, while Meta's revenue growth was supported by the higher advertisement pricing and an engagement. And the recent job cut at Meta should help the company to maintain its adjusted operating margin about 40% this year. And Apple, which reports on Thursday, may miss its revenue target for its first quarter results. And the outlook for the quarter ahead likely disappoints with the sluggish consumer electronics market. And China's latest smartphone trading subsidy won't likely benefit the company, as most iPhones don't qualify for the program.
Reina Sasaki there, thank you so much. Our Bloomberg News earnings specialist on a preview of the Speak Week ahead. Mag 7, well, some of the Mag 7, there's a Fed decision as well coming through. And of course, this DeepSeek conversation is expected to permeate beyond Monday. Plenty more ahead. This is Bloomberg.
And welcome back. You're watching The China Show with me, Stephen Engle, and David Ingles. All right, here's some of the top stories we are following. U.S. Secretary of State Marco Rubio has expressed concern about Beijing's, well, in his words, coercive behavior against Taiwan and alleged aggression in the South China Sea. The comments come after his first formal call with Chinese Foreign Minister Wang Yi. Rubio also emphasized the new U.S. administration would pursue a relationship with China that, quote, advances U.S. interests. Well, Pete Hegseth has been confirmed as the next U.S. Secretary of Defense, despite allegations of spousal abuse, excessive drinking, and financial mismanagement, which he denies. Hegseth is a combat veteran and a former Fox News commentator. Lawmakers voted 51-50 to back him, with Vice President J.D. Vance casting the tie-breaking vote. And the CIA now believes it's more likely the COVID virus originated from a lab leak rather than a natural source. The new view aligns the CIA with the FBI and the Department of Energy, which say the virus probably leaked from a lab in Wuhan, China. The announcement comes after new CIA Director John Ratcliffe declassified existing information. And Yonhap News says the South Korean prosecutors have charged President Yoon Suk-yeol with insurrection for his attempt to impose martial law last month. Yoon is the first sitting president to be charged while in office and can be detained for up to 6 months while his case is reviewed. The indictment comes just months before Yoon was due to be released from detention on Monday.
Okay, let's take a look at the latest in markets. And man, this is a fast-moving story right now. Who would imagine we'd be seeing U.S. futures down about 1%? Just for context, right? We're not used to seeing moves this big either side of zero on U.S. futures in the 8th session, which really underscores that there is something happening or repriced right now. And a lot of this and we're pointing now the finger at this DeepSeek trade that is effectively hedged a massive wedge between where you are on U.S. tech and, as you can see, some of the AI-related plays onshore in China, which are limit up in many, many cases. So, yeah, in some ways, these are two different types of investors, too, right? You have an onshore investor that is really going long and going along quite big on this. There's a global investor that is taking some of the froth off the table, and the iteration of that is a hedge coming through in U.S. futures ahead of some key U.S. tech earnings as well this week. So just watch it very, very closely and how this, I guess, story evolves. And it's worth noting, right, there's an extremely wide gap in valuations between these two things. So on top of these names, things like SenseTime, for example, Baidu, some of your household names that you might be more familiar with are also doing exceptionally well as we speak here, Steve.
Yeah, I think what we really have to watch out with these Chinese players, with what DeepSeek is doing, is showing these large language models in China can thrive at a much lower cost basis.
Yeah.
And where many of the open AIs and others in the West see, they're investing billions and they're expecting billions of returns.
Well, it's cheaper to develop. It's largely cheaper to use at this point in time. In terms of the major metrics, they're almost at par with each other. We'll unpack the story for you in the next hour of the China Show. All right, welcome to the second hour of the program. And as you can see, the CSI 300 on your right. And as Steve was pointing out, it's an extremely truncated trading week onshore as we move into, of course, Lunar New Year. And, of course, this massive window of the markets being shut onshore. We're giving up most of the gains from earlier on in Hong Kong, that we have, I think, about one more day left. And apart from this, so in other words, the runway is short, but man, this runway is busy today as people reprice this U.S. versus China tech trade, Steve.
Absolutely. I mean, the DeepSeek kind of crept up on us, but it's been around, and it was the talk of Davos I'm hearing last week. People are saying, who is this, and how are they doing, catch up on their large language models so fast and so cheaply, dare I say. Right? So that's why there's a lot of different sentiment going on there. China PMI gauges also reflecting return to pessimism in the manufacturing space in China at 49.1 for manufacturing. We were expecting 50.1. Of course, 50 is the line of between the demarcation, if you will, the DMZ between positive sentiment and negative sentiment. So we're dipping deeper into that 49.1 into pessimism for manufacturing. Even services, non-manufacturing, Dave, went 50.2. We were expecting 52 plus. So sentiment right now heading into the Lunar New Year holiday in manufacturing and services sectors not starting off too well. The last days, essentially, of the Year of the Dragon.
Yeah, and I think it was largely unexpected because it missed on the forecast. But I think our guys at Bloomberg Economics had really saw this coming because it was really the front loading of exports ahead of potential tariffs, which, by the way, haven't come yet. Which was the tailwind here, Steve? Sure.
I mean, in December, we saw a jump up of 10% in exports. And a lot of that was front-loading ahead of expected tariffs. And, of course, these surveys, the PMI, do not necessarily reflect the opening days of the Trump administration where they did not slap on those 60% tariffs. So you have to take those opening month numbers with a bit of a grain of salt always because of the distortions of Lunar New Year, and this year in particular because we didn't necessarily get what we were expecting from Donald Trump on day one as it relates to China trade.
Yeah, well, the night is young, as they say. We'll see what happens with that. The other market story, of course, that we alluded to here is this, since we're talking geopolitics and trade, let me just take a fancy word from there and use it in markets, bifurcation between U.S. and Chinese tech. So a lot of the names you see on your screens are the names tied to, of course, the NVIDIA story and this U.S. tech AI play, right, that are traded across the region. These are the names tied in the U.S. And as you can see, really taking a massive backseat today. This DeepSeek angst that we're seeing in some parts of the of the equity market in the region. Now, I think related to this, Steve, yeah, you go ahead.
This is not angst. This is a knee-jerk reaction, isn't it, Dave? These are sharp numbers.
Very violent, in fact. We'll see how long it lasts. But,
yeah.
I mean, 8% drop, really. And by the way, I should also mention as well, right, these are some of the names that have been bid up massively over the last 24 months or so, because these are the names that have been riding the NVIDIA wave as well. I think it's worth noting as well that you have a lot of markets in the region shut today. So in other words, if Taiwan was trading, I would imagine that would show a similar vibe to what we're seeing over on the Japanese side. Can we please show, do we have the U.S. futures, please, on your screens? As you can see, 0.9 of 1%. Do we have, I want to show Hang Seng Tech stocks, please, if our viewers can see that. Also, some of the related stocks that we're seeing in the onshore market limit up on the back of this story. As we try and get that up for you, there we go. U.S. futures down, and some of the mainland-related AI plays are limit up. Oh, this is a story that we weren't expecting to talk about, but here we are. To help us unpack this, the initial goings is Kyle Rodda, Senior Market Analyst at Capital.com. Kyle, good morning. I was initially going to ask you about the Fed, but that seems to be a nothing burger anyway this week. Well, who knows? But why don't we get started with DeepSeek? And what are your initial thoughts on this trade today?
I think we've got something new entering the narrative now, which, you know, if you really look at inflections in the market, and again, this is very early and we're talking in a very speculative way, that, you know, normally when inflections do occur, it's because either one narrative flips 180 degrees on its head or a new narrative enters into the equation. And, you know, a lot of the talk, obviously, earlier this morning was that the initial moves in the market might have been due to trade wars, and we're tying that back to Colombia. I think increasingly, as we've unpacked the price action this morning, this is the DeepSeek story. And, I mean, over the weekend, if you look at social media, if anyone's on a sort of group chat with equity investors or any kind of equity strategist, you know, phones are running hot, effectively talking about, well, what is this product? How have they achieved these outcomes? And what does this mean for the AI investment boom in the United States? And not only that, geopolitical risk between the US and China, because all of a sudden that kind of proverbial arms race in technology investment and AI investment has taken a very, very interesting turn, where now China looks like a very viable competitor and a competitor that, you know, perhaps might catch the ire of the Trump administration. So if you look at it from numerous perspectives, you know, it raises concerns about overinvestment in artificial intelligence. It raises concerns that perhaps, you know, the United States might have the competitive advantage that it has over the rest of the world. It raises concerns that, you know, perhaps chip demand won't be as great going forward either, and companies like NVIDIA are overvalued. So again, very speculative, very early days. You noted that there are a lot of markets closed in the region, but I think it's fairly clear now that the markets are responding to this new information, and I think this is the first kind of new bit of different narrative, if you will, to enter the market conversation in 2025.
Yeah, Kyle, we might have to wait till after the holidays to see if this rally has legs, as Dave mentioned. He also mentioned the Hang Seng Tech Index. It's been up now 8 of the last 10 sessions. It's up another 1% today. It was up 3% on Friday. Could we be seeing, though, some significant legs through the Lunar New Year into tech as a proxy to the China play in AI through Hong Kong?
Well, I think so. And I mean, if we go back to last week, I think last week, the narrative, we want to continue to talk about narratives, was about, you know, trade tensions and the fact that the Trump administration seems to be taking a far more, I suppose, considered response, or considered approach, I should say, to potential tariffs on China. And I think that's effectively why we saw some of the, you know, improvement in market sentiment towards Chinese equities, mainland, as well as obviously the Hang Seng. But once again, you know, if we start to see this new narrative about DeepSeek and, you know, the advantage or the potential competition that China can offer the US tech players, that really is something that can quite significantly shift valuations and more or less lead to a reflation of multiples that have been very depressed because of obviously the very well-known risks to investing in China, whether that be, you know, country risk, trade war risk since the Trump administration has taken the reins again, or just simply the fact that we're dealing with probably what can be best described, like Richard Koo says, this sort of balance sheet recession, depressing economic activity. All of a sudden, this is a reason for multiples to expand again, which, you know, still historically depressed, although not as bad as 12 months ago, and see flow going back into the market again, despite some of those risks still persisting. So this could be, again, a significant inflection point if this proves to be as significant a change as many are speculating at the moment. And because, like I said, those depressed valuations in the market, it says that we might see a little bit of reflation there.
Yeah, Kyle, a lot of ifs really to the story, and I mean the timing could could not have been worse or perfect depending on how you're looking at this. This is the dilemma, and the reason I phrase it that way is we have massive tech earnings out of the U.S. this week, and history has showed us it's a massive risk to be underweight U.S. equities during earnings week.
Yeah, certainly. And we have seen a history of upside surprises, although, perhaps arguably over the last few quarters, especially in NVIDIA, those upside surprises have diminished a little bit. I mean, I think before we had this development today and, where we were sitting, maybe only 48 hours ago, was that we were looking at a US stock market that was looking very, very positive, perhaps for all its sort of knocks on it, whether it be stretched positioning or rich valuations. We're looking very, very strong, and part of that was a fundamental story. But because things, again, were looking a little bit rich, we're at a stage in the market where things were looking very, very good because of the fundamental outlook, but perhaps prone to shocks. So the entry of this kind of discussion into the mix sort of begs the question whether those likely upside surprises from tech companies, because we do know that they sort of lowball expectations going into reports so they can sort of exceed a relatively low bar, maybe watered down a little bit. And the thing that might enter into the conversation a little bit more, especially on earnings calls, is whether there is a degree of overinvestment going on, or whether they're running models that aren't competitive compared to, again, some of these upstarts and startups, intentionally using both words there, emerging in China and potentially in other parts of the world once we get a better sense of how these companies have established themselves and scaled, that could disrupt that AI trade. So it makes it very interesting. And again, it's a market that's richly valued, looking fundamentally strong, but prone to shocks. And this may be one of those new shocks that could, at least lead to some sort of a drawdown or correction in valuations.
Well, speaking of shocks, we have seen them in commodities over the years, obviously. You do believe in gold has further legs upwards. And on the flip side of that, with Donald Trump using those words, drill, baby, drill, essentially there could be a little bit of downside on oil.
Yeah, one's more of a long-term play, one's a sort of slightly more short-term play. I think, obviously the marginal player in the market when it comes to energy is OPEC. And we have seen, to their credit, OPEC's ability to be able to manage the range in crude prices, and by extension, broader energy markets across the world, which have been a little bit more prone to supply shocks between, if you call it on the West Texas Intermediate contract, between 65 and 80. This kind of drill, baby, drill mantra in the United States, again, changes the story a little bit when it comes to global energy markets. May see oil move closer towards the bottom end of that very well-managed range. When it comes to the gold story, there's just so many things to like about the yellow metal at the moment. And I think at the moment, what's really driving prices higher and out of what has been a fairly technically constructive breakout is the fact that there is this concern about debt and deficits in the United States and a build-up in other Western countries as well of debt and deficits, and a desire to kind of get a hedge against that play. And there's also these simmering trade war risks which lead into that kind of de-dollarization dynamic and that increased central bank buying of gold. The thing that's standing in the way of gold at the moment, or at least recently, has been a strong US dollar, which I believe personally is about to turn as well, partly because of positioning, partly because of changing fundamentals. And the other element too, as a corollary of that, is the Fed potentially not cutting as much as expected, or maybe even leaving interest rates unchanged. But if you look at the balance of risks, I think it supports the notion that those factors driving gold, the tailwinds for gold, are more likely to persist as tailwinds are unlikely to reverse and become headwinds than the other part of the narrative, the headwinds, are more likely to sort of become, sort of tailwinds and continue to support this sort of rally in gold. So I think 3,000 is a level that we could really eye off before the end of the year, and I see a lot of positive reasons to be kind of bullish on gold.
Kyle, just to take many of the themes you just outlined for us there, but look at it from a dollar perspective here. Do you think the dollar started its correction, or is this a temporary softness amidst the bull market in the dollar?
I think a lot of it will depend on the trade war dynamic, because I think what was revealed over the last couple of weeks is that, maybe even the markets were under appreciating how significant, the trade war was really in sort of depressing equity momentum and also putting upside pressures on the US dollar. If that remains fairly contained, and we do see this kind of, more considered approach from the Trump administration to tariffs, Again, this DeepSeek story maybe changes that a little bit because it raises the stakes a little bit when it comes to strategic competition. But let's just assume that continues to be the case. We're also starting to see momentum in the US economy sort of moderating just a little bit. Some of those disinflationary pressures are seemingly persisting. And there are also some elements there to expect that maybe the rest of the world is starting to sort of improve as far as economic conditions go. Not so much to sort of see a very significant lift in economic activity around the world, but some of that divergence between the United States as well as the rest of the world is starting to sort of moderate slightly. So that, combined with a little bit of positioning and a little bit of a historical precedent where after the Trump election in 2016, we saw this big rally off the back of the election in the US dollar before it eventually reversed and spent the rest of the following year in a bit of a downtrend. I think we're starting to see that dynamic playing out a little bit. You can even throw the Bank of Japan there as a bit of an example as one there where the yen's going to appreciate and put some modest downward pressure on the dollar. I think that shifts a little bit. Again, good play for gold. I think if we continue to see these sort of trade war tensions just simmer without sort of escalating too much, the Aussie dollar and the euro starts to perform as well. So I think the risk and reward looks good in terms of the short side for the US dollar.
Well, Kyle, I'm glad you brought up the yen and the BOJ on Friday. It was pretty much of a hawkish hike there. We were expecting a dovish hike. It was still 25 basis points, but still sort of telegraphing that there could be a couple more hikes left in the bag this year. But the yen hasn't moved much. Yes, it's moving today a little bit. It's 155.48 right now, but still hasn't gotten that traction. That's probably what the people I've talked to is dollar strength more than yen weakness. But how much more upside do you think the yen could have?
I think the yen has a lot more strength to go. I think, again, a part of that is just because of, the US dollar trade starting to unwind, and that will be more important. I mean, if you just sort of take a very, very simple approach to it and you sort of track the USD JPY over sort of the US 10-year yield, that's been, the clear play. And there's still upside risk to yields too, it has to be said, with, the kind of fiscal agenda that we're going to see under the Trump administration. But overall, I think if you do listen to what the Bank of Japan said, they think policy is still accommodative. Real yields are negative. By their reckoning, to be able to bring inflation down, which is clearly accelerating as we saw on Friday, it's going to have to hike even further. That says to me that, there is also some, yen bullish factors playing out there because of what will be eventually more hawkish policy from the Bank of Japan. So we didn't see a huge move, or at least follow through, probably is the more appropriate way of phrasing it, from the Bank of Japan. But if you follow their logic and you follow, what we're sort of seeing in Japan's economy as well as the global economy as well, that all suggests that there needs to be tighter policy because of a strong Japanese economy. That means that the Japanese yen will have to appreciate a little bit. And then again, when you throw in the dollar story to that, I think that puts a fairly good framing on where the USD JPY goes from here. So again, I think it's a good story for the yen from both the dollar side of things as well as the yen side of things.
All right, Kyle, thanks so much. Kyle Rodda, Senior Market Analyst at Capital.com. Thanks for joining us this morning. Well, we have more on DeepSeek coming up. Bloomberg Intelligence joins us to discuss its rise and the challenge it poses to U.S. rivals.
Right, just ahead, we will also be talking to veteran investor Raymond Chan. So we're talking all things distressed opportunities and sort of the risks to watch here. Is it more a private market play? Or is this market giving us something to talk about in the public markets? More on that in a moment. This is Bloomberg. Welcome back. All right, a look at U.S. futures. Yes, in case you're just joining us right now and wondering why some of these contracts are down 2%, 1% on the S&P futures. Yeah, well, you got to blame is it the bandwagoning? Is that the verb there on the DeepSeek trade? So the opposite of this is obviously a lot of the related stocks in China are actually moving to the upside here. And might this give you something to think about as far as stretch valuations in the U.S.? And is there an alternative, actually?
Yeah,
I think it's a question here.
Seeking deep meaning, going deep into this story, obviously. Investors are, too, trying to figure this out. Is it a trend, or is this, a short-term trend, or is it something a little deeper, dare to say? All right, over the past few days, a Chinese AI company has been making waves in Silicon Valley, and my pen just dropped onto the floor.
I'll grab it for you. But yeah, go ahead, keep reading.
That's because AI models from DeepSeek have been scoring impressively on global benchmarks. The free open source large language model was unveiled in December. The lab behind it says it took 2 months and under $6 million to build. I think that's a key point right there. That's a fraction of what OpenAI and Google spent to train their models. Dave?
Yeah, $6 million.
How much has OpenAI and Meta and Google and Tesla spent combined?
Well, I know of more expensive apartments in Hong Kong than the budget it took to get us up. Last week, the founder of DeepSeek was the only AI leader selected to attend a meeting of entrepreneurs with Chinese Premier Li Qiang. And over the weekend, Xinhua published this editorial on how China's AI advances are working, despite Washington's tech curbs on the country. Robert Lee is with us, our Bloomberg Intelligence senior analyst. So, you told us so.
Well, we've been writing on this company for the best part of 6 or 7 months. And I think for anybody who follows the China AI sector closely, as we do, the profile has been relatively high in this part of the world. But what you've seen over the last week or so, prompted by the coverage and, as you said, the meeting with the Premier, it's helped raise the company's profile both nationally and also externally. And this story's been picked up by a number of external news outlets. But, Bloomberg Intelligence, some lead, others follow. We've been, very active on this for, as I said, for quite some time.
It was the talk of the town in Davos, from what I understand. So what is the secret sauce, if you will? Is it the low cost, or do they have the processing power for the training and the deep learning?
Yeah, well, taking a step back with the export restrictions you saw on the NVIDIA chips, etc., has been a major challenge. There is clear evidence, I think, that the big tech platforms, the Alibabas and Tencents of this world, both preemptively accumulated inventory of chips beforehand and have maybe, gained a helping hand from their friends in other parts of the world to gain access to these chips. But then for smaller companies such as DeepSeek, although they still have access to a sufficient number of chips, this challenge has prompted them to become more innovative. And so the way in which they've developed the models is a far more computationally effective and therefore requires less chips and allows them to undercut their rivals cost-wise or price-wise significantly. So without going into the technical detail on DeepSeek, it's something called a mixture of experts. It's the architecture they use. One of the first in the industry to do this. They've really managed to forge ahead. And as you mentioned in your preview, are ranked top 10 in terms of global large language models. So I think, again, this just highlights and illustrates the point that whilst Chinese tech companies faced, problems on the semiconductor and chip side, they have a very strong track record in terms of innovation and software. Alibaba, Tencent are two of the world's leading tech platforms. And that, in numerical terms, China has more software developers than the US by a ratio of approximately 3 to 1.
And what does this mean for US AI in particular?
Again, I think, the Microsofts, et cetera, of this world were undoubtedly aware of DeepSeek. But, it's the headlines that have probably prompted them to have a little bit of a rethink and think how they can compete on this. I think one consistent point we've made over the last 18 months or so is that the technical barriers to entry on software are not as high compared to something like semiconductors. So I think there's already evidence that some of the US companies are moving to this mixture of experts architecture, and I would expect the rest of them to follow. So perhaps that could mean that DeepSeek's progress is forestalled to some degree, but I still see it as, one of the leading large language model developers out there globally. But again, it just shows that China is very closely positioned as the number 2 competitor to the US in AI globally on the software side.
Robert, fantastic. Robert Lee there out of Bloomberg Intelligence. Plenty more ahead. This is Bloomberg. Right, welcome back. Just a brief look across some of the other sectors. There are other market stories today. Media and movie-related plays are on the back, moving to the upside here on the back of, this is a policy support story that's playing out across these markets. We're looking at some upside here across some of the related names in the broader industry. Macau casino stocks, as you can see, coming through as well. There's a report of strong hotel demand as we move into the thick of the sort of Lunar New Year holiday, and we are just on the cusp of a very long holiday, of course, coming through on the Chinese mainland. We'll be on top of the story. Suffice to say, it's been a good time to be a long these Chinese markets as we move into the thick of the Monday session. So the story across markets, a softer dollar broadly speaking. Equity markets that are rallying in the Asia Pacific outside of the big chip plays. U.S. futures are down. Chinese equities, an hour in, are doing very well.
Welcome back. You're watching the China Show. It's 11:29 a.m. in the city you're seeing there, Tokyo, and about to go on break in just about a minute. We're seeing some weakness in the Nikkei 225, down about 0.5%. The broader Topix, though, up by 0.5%, and the yen is strengthening a little bit by about 0.25%, as you can see, to 155.56 on a little bit of broader dollar weakness. Going forward. Of course, some of the Japanese stocks in the tech space feeling a little bit of heat from the story du jour, and that is DeepSeek AI out of China. So we're going to have to watch that as we head into, of course, the long Lunar New Year holiday that begins tomorrow on the markets, at least in China. So you can see some significant downward pressure on some of these tech-related stocks in Japan, including SoftBank, and my eyes are not good enough to see the other stocks. Is that Advantest?
Advantest, Disco, which is a former... it's what we used to call clubs back then, right? There we go, Disco and Fujikura. There we go. Okay.
We need to boost the font for us.
Yes.
50. So I don't know how old you are, Dave, but
we need to average down the age, really, as a broader solution to this as well.
Let's change gears and look at the property sector. Obviously, Chinese developers are in focus this week, with courts in Hong Kong holding hearings on winding up petitions for Times China and Hellenberg Properties. China Vanke also faces the first payment for more than $1 billion in onshore notes that mature this quarter. Let's get to our credit reporter, Loretta Chen. So, Loretta, what's the latest on the distressed developers? Obviously, this is an ongoing story right now. Give us a pulse check right now, given these meetings that are going to be held.
Yeah, there's going to be several court hearings in Hong Kong regarding to the winding up petitions against some Chinese developers that have already defaulted. And then China Vanke, of course, has this big maturity in the onshore market. Well, market expectation is that Vanke is going to service that debt onshore, as usually the Chinese developers tend to prioritize their onshore debt maturities ahead of their offshore debt. Vanke has another offshore maturity this March, so that will be in focus by the market. I think what's the latest regarding Vanke is whether that government support will materialize into some actual funding being injected into the company. I think people are watching closely the kind of meetings that's been held in Shenzhen between the authorities and the company.
Well, separate story, but related, obviously, in the bigger scheme of things, is your team has actually written about the saga, this continuing drama we're seeing with some Hong Kong property names and what the exposure is of the banking system. Tell us more about that piece.
Yeah, so we had this latest story that's basically saying the property slump in the Hong Kong market, especially the commercial property sector, has eaten into the balance sheets of banks. So in the past, banks have this sufficient cushion of around 50% loan-to-value ratio, which means that for 100 million property, they usually only give out half of the loan value to protect themselves. But with property values really slumping so much, we're seeing some banks actually taking hits on their loans. So before, the bottom line of most banks in Hong Kong, the commercial banks, are that they're not selling or disposing of assets at a loss. But actually, recently, we've seen cases. So the most recent is Chuan Case Center in November. It was sold to the Metropolitan University in Hong Kong at a loss that's really taken around 2 billion Hong Kong dollars off the banks. So the banks are taking direct hit, which was kind of unimaginable, really 1 or 2 years ago.
I mean, there is a lot of pain in the sector, and I think the point that we were joined earlier on by Lung Properties, of course, the chairman there, Adriel Chan, who talked about the office sector, and he doesn't see an end in sight really, just because of all the new buildings that some of which have blocked our view right now here outside our set. But anyway, thank you so much.
Thank you.
Loretta Chen there, of course, on the latest there. Right, so there's a lot of distress in this market. In fact, one of our pieces today as well on the Bloomberg terminal, apart from the fantastic piece that Loretta and her team had put together as well, is also the call coming out of PineBridge and JP Morgan. They still remain bullish here on this wobbling junk bond space. Read about that, of course. A lot of opportunities here. To talk us through the opportunities, broadly speaking, joining us here on set is Raymond Chan, Chairman and CIO of the Opportunities Fund at Blue Mountain Bridge Capital. It's nice to see you. Good morning.
Hi. Thank you for having me.
So you must be a child in a candy factory, given all the distressed assets out there. How would you describe the current market situation?
I think let's first starting with the China property market. I think what the government did over the past 3 years, their ratification effort have massively corrected the property sector. What happened over the past is that asset prices have gone up, and private developers borrowing has also been going up, and up. And you can see, given today's, we have over 3 billion square meters of pre-sold but unfinished property in China. And basically, private developers are facing a funding gap of about 4 trillion in order to finish this and deliver it to the end user. So all these, the current assessment is basically, all these private developers are still working out, plans to repay their debt. And investors basically have two choices. One is to restructure the debt or face, do a liquidation. But of course, many of these creditors will not be able to get par value back. And even though restructuring may be a long process, but it's a lot better than a liquidation. So from an investor point of view, for ourselves, for our funds, this is the best time to be in the market. I've been in this space for over 30 years now, focusing on China properties and Hong Kong properties. And the distress is, for Hong Kong and for China, prices have corrected enough for us to look at it at this point. Everything is starting to look interesting right now.
So before we get into the actual specifics of what you are selectively looking at, compare what's happening in the mainland to what's happening in Hong Kong, because it's lagged considerably, the stresses on the mainland. Different scenarios, obviously, and the banks here are highly capitalized as well. So there's not necessarily a systemic shock. But how do you see this commercial real estate market right now shaking out in one of the worst slumps on record?
In Hong Kong?
Yeah.
Well, just too much supply out there, and then it will continue to come up with new supply in the coming 2 years. But for us, we are focusing at this point on the credit side, the private credit. So for private credit investor like us, even though we can look in equities as well, but have never seen a cycle where credit opportunities out there and the return that it generates, it's a lot better than what I'm seeing over the past 25, 30 years. You basically, as a private credit investor, you're coming in at a loan to value of 50 to 60%. You're not coming in at the equity value. You're not coming at the market value. You're coming in at a 50 to 60%. So there's a lot more cushion that you can play with. And especially when values in the market right now for commercial property or for residential property have gone down so much, your value is already reflected that, and you coming in at 50 cents on a dollar, it's a lot, attractive for people like us.
Is it easier to distinguish between residential and commercial at this point? Like, is there something that stands out to you between the two as perhaps a lot more useful information, let's put it that way, to do what you do?
I think commercial property definitely has a lot more risk than residential. Residential is actually end user demand. If something goes wrong, there's a buyer out there to get you out. Commercial properties a lot more difficult. It's en bloc. There are a lot of strata title sales in Hong Kong. Maybe perhaps what you can consider is a strata title office that you lend against. But for us, we are looking at both residential and commercial collateral for our private credit investment. But in the end, the market is at a distress level. We are looking everything from a special situation angle. So we are no longer lending against very, very high value. Today's market have, especially for commercial property, have corrected 25 to 30%. So if the overall value have come down 25, 30%, we are lending 50, 60 cents on the dollar for that.
Wow.
You can imagine, we coming in at a very, very attractive entry point.
So this year is really the year for you right now. I think we did an interview with you back in October of 2023. You saw the next 2 to 3 years as being the most opportunistic cycle that you've ever seen. So how does your portfolio now look going into 2025 as the strike while the iron is hot?
Yeah, last year we made a couple of investments. We exited one of our major investment in December, and it didn't default, but we got our high teens returns even for a credit investment, and we have a strong start in 2025. We see a lot of distress opportunities out there. Our pipeline, it's showing that, especially in Hong Kong, you don't have to go to China to get those kind of opportunities. And we just closed one last week. Where it's a great start for us for 2025. Again, it's private credit investments. We're lending it at 50 cents on the dollar, and it's generating high teens returns.
What's your typical holding period now?
Holding period, we like to keep it short, 1 to 2 years.
Wow, that's short.
Yeah, 1 to 2 years. But we could go as long as the way that we structure our deals is that we have an option to extend. Whether it's a 2-year deal to a 3-year deal, whether it's a 1-year deal to a 2-year deal. Right now, you keep everything short. And
why is that? I'm just curious. Is it because the nature of market opportunities right now?
Yes. And also our capital is basically locked up for three years for now. But and investors, we want to return money to our investor quickly as possible. No, it's. Compared to 4 or 5 years ago, it's very difficult to see, 5 years out or 3 years out. But I can definitely see 1 to 2 years out where things could turn out. But, it's very difficult now to see beyond 2 years, 3 years.
Right. With so much distress on the mainland right now, how selective do you have to be? And what do you look at specifically?
In China, we these public bonds, we look at it. It's especially the offshore bonds. It's starting to look at it. Become a little bit more interesting, but they're pretty deeply subordinated, especially these offshore bonds. So, onshore, we look at asset that we can lend against. That can generate yields. In Hong Kong, they still have negative carry. What that means is that the property is not generating enough yield to pay off the debt. But in China nowadays, you see a lot of income-producing property that can generate high single-digit, double-digit yield. And as you guys all know, that borrowing in RMB is a lot cheaper nowadays. So there's a huge positive carry in China. You haven't seen that, probably 4 or 5 years ago, but we are seeing that right now. So we are lending against these property that's income producing, that's a positive carry. In Hong Kong, we're doing the same thing, but it's not as distressed as in China for the time being.
As you mentioned earlier on, you've been doing this for a couple of decades now. The reason I bring that up is not to show your age, but in recent years, we've seen a lot of money come into private credit. It's almost, the concept gets tossed around almost as if people understood, or the people getting in understood what it was. And I'm wondering, how are you looking at, well, number one, competition, And is there too many money chasing too few good deals, or is just too many good deals out there right now for everyone and their dentist?
Yeah, the good thing about currently is that because of the geopolitical risks and tension right now, there's less, foreign money chasing deals in this region, especially China and Hong Kong. That leaves us a lot more opportunity. We are very selective in everything that we do, and one thing is that we're not competing with the big guys, the big funds, the Blackstone of the world, the Oaktree of the world. We are looking at a certain segment where between $25 to $100 million deals, and there are plenty of that around in Hong Kong and in China.
You obviously look at the situation in China with microscope and seeing where the opportunities are. I mentioned a couple of years ago when you talked to us, you saw a 2 to 3 year cycle of great opportunity in distressed debt. Where are we in that cycle right now? Have you seen indications that things will turn?
Turn for, you mean the...
Well, the fundamentals, you said, in some cases, are starting to have cash flow positive, and you're seeing those kind of trends. Are you seeing, though, that the developers are getting a little bit better, or is there further shakeout to come?
China have gone through a massive correction period. So what that means is that, it's stabilized. Developers for new projects are buying land that can generating reasonable margin. And you can't say that about 4 or 5 years ago. Everybody was fighting and borrowing more and more money to be squeezed out. But nowadays, everything is more affordable. So we see opportunities where we can go in with potentially one of those developers. But the opportunities right now in China, it's a plentiful, but as you said correctly, it's like we got to be very selective in China. But in Hong Kong, we are seeing plenty of that. Remember, a lot of these developers came over to Hong Kong when they have a lot of money to buy asset here.
Right.
Now with that, with the problem they have onshore, they want to sell the asset in Hong Kong, just like what Loretta said a few minutes ago. We see those kind of opportunities, but not from an equity point of view, but more from a private credit angle, which is a lot more interesting.
A final question for you, and I have to qualify the question because this conversation has been about distress. I'm not talking about a distressed asset, but what are you hearing about New World?
New World, well, first of all, they've gone through a few management changes, and it's one of the family owned business in Hong Kong. In Hong Kong, remember, China went through 3-4 years for corrections. Yeah. Now the prices have stabilized. In Hong Kong, are we starting to see the beginning of this? I don't think so. They have a lot more cash in terms of, if we focus on New World. But in the end of the day, what New World needs to figure out is that, they have a lot of bank debt coming due this year. They need to fix that first before they fix the bonds. The bonds maturity it's behind the ones that's the bank. Yeah. So now, if the creditors need to work out a plan with the banks, what is the families going to do in terms of will they inject money in? Will they put more asset against these capital, against these debt? So the bank's point of view, they have a first dip, right? And then the bonds, you can play it later, whether it's the 26 bond, 27 bonds. But in the end of the day, what New World need to figure out is, and I'm sure they have plenty of resources to get this thing done. But I just think that it's not as bad as what happened in China over the past 3-4 years.
All right, Raymond Chan, Chairman and CIO of the Opportunities Fund at Blue Mountain Bridge Capital. Thanks so much for joining us here in the studio. All right, plenty more ahead on this very busy Monday morning in Asia. This is Bloomberg. And welcome back to the China Show. Here are some of the major political stories we are following. U.S. Secretary of State Marco Rubio has expressed concern about Beijing's, alleged coercive behavior against Taiwan and aggression in the South China Sea. The comments came after his first formal call with Chinese Foreign Minister Wang Yi. Rubio also emphasized the new U.S. administration would pursue a relationship with China that advocates U.S. interests, quote unquote. Well, South Korean prosecutors have charged President Yoon Suk-yeol with insurrection for his attempt to impose martial law last month. Yoon is the first sitting president to be charged while in office and can be detained for up to 6 months while his case is reviewed. The indictment comes just before Yoon was due to be released from detention on Monday. And a new government poll suggests many Thais disapprove of plans to allow investments in casinos and online gambling. The survey found about 59% oppose investments in both casinos and so-called entertainment complexes, and almost 70% of respondents don't want online gambling legalized. Prime Minister Shinawatra has sought to assure citizens the initiative will bring economic benefits. It's a hot-button issue, Dave, in Thailand. They're talking about 2 casinos in Bangkok, one in Pattaya, one in Phuket, and elsewhere.
Yeah, to further that massive tourism engine that they got going already. Well, speaking of casinos, currently the option is, at least for Hong Kong, is a near option, which is in Macau. And based on the reporting here, that there is some strong demand going into this Lunar New Year holidays. Stocks are up, and broadly speaking, of course, Chinese markets are doing very well this Monday. Plenty more ahead. This is Bloomberg. Right, welcome back. We're looking at, so dollar is stronger against the Mexican peso. Of course, if you missed it, some of the proxies here, the Colombian, U.S. and Colombia and the tariff conversation there. You're getting some weakness also coming through as far as the South African rand is also concerned. Now, separately, Steve, there's the story also on New Zealand easing its visa rules to allow visitors. I'm trying to make out what that actually means based on the headline itself, but it effectively means that allow visitors to work remotely that makes sense now. In New Zealand. I was about to say, like, if you're allowed to work remotely, why even go to New Zealand?
Well, they've been targeting highly skilled people, particularly IT workers from Southeast Asia and the U.S., to attract foreign talent and investment. So they're just easing those rules to allow that to happen.
Yeah, there we go. Come over, chill a little bit.
Work from home.
Yeah, why not?
Up from the beach.
From
Robertson.
And you can use the AI tools of that. Here's the segue to this. And on top of the usual chatbots that you might already be used to, there's one that's really wedged itself into the global conversation. DeepSeek. And it's playing out across these markets. U.S. futures are down 1%, and some of the Chinese plays on the other side of this are actually catching a very, very strong bid, like SenseTime, like Baidu here, Steve.
Yeah, that's right. So this is going to be something we're going to be discussing. But, again, the Chinese markets go dark for a few days now because of the Lunar New Year holiday. Happy New Year of the Snake coming up to our viewers.
Yeah, almost there. I think we have a couple of days left, at least
Wednesday
here.
is New Year's Day.
In Hong Kong, right? Oh, well, New Year's Day is Wednesday. That's right.
Yeah, that's right. Yeah. So out goes the dragon, in comes the snake, right?
Yeah. Sure. Right? Isn't it she? Yeah. Okay, there we go. Year of the Snake coming through. Okay, Nasdaq futures down about 1.7%, and the states of this Hong Kong market going into the last hour of trade is looking like this. Hang Seng Index 20,000 and a couple of hundred in. Do we have that in so we can show our viewers? Thank you so much. That's it from us here. Plenty more ahead though on Bloomberg TV.
新年快乐.